Are you ready to overcome the complexities and burdens that come with your success? Join the team at Centura Wealth Advisory in the Live Life Liberated podcast. Now, on to the show.
Welcome to Live Life Liberated podcast with the team from Centura Wealth Advisory. Hosting this podcast is Matt Griffith and Sean Clark. So, Matt, what will you two be talking about on this edition of Live Life Liberated?
Thanks, RJ. Yeah, we're excited to get into it today. A lot of public stock market volatility lately. So we're going to talk about investment behavior and discipline in volatile markets. And, our target audience here would be your founder-led business owners, those operating a business, maybe even those considering a disposition of the business, corporate executives, and also, those that either in retirement or considering retirement. And so we're just going to jump into it, Sean. I want to set a little context here because this is April of 2025, and it kind of timestamp where we are here. I think it's important to talk a little bit about the background and history of just markets in general. We don't have time to get into the full history of markets, obviously, but going back, we could cite throughout my 20 plus year career, it's, I started around the tech bubble days, and tech bubble and ultimate burst in the early 2000s. Not a fun time. We had the Great Recession in 2008, maybe more recent, what you would talk about COVID in 2023 when it was significant volatility in March of 2020. Well, now here we are in April of 2025, and we've kind of seen the markets whip back and forth. I wanted to share just a few data points of just, again, sort of some recent data to set the stage here. And I'm going to talk about the S&P 500, so our largest U.S. companies by market capitalization. 2022, the S&P 500 was down over 18%, just a little over 18%. 2023 bounces back, big year, 20 plus 26%. 2024 plus 25%. So 2 years in a row of 20 plus % returns. Not a lot of times do you go and have a third year in a row of 20 plus returns. So I don't think most people were expecting to layer another year on, but we started the year, the S&P 500 was at 58.81, got as high as 61.44 on February 19th. And then we started to see a little bit of a pullback from there. In early April, they, of course, announced some tariffs on April 2nd, kind of caught the market a little bit by surprise. Not necessarily the tariffs itself, but the rate, I think, and the number of countries involved. We saw the market dip then from that high of this year, 61.44, all the way down to 48.35. So we're talking 20% correction territory. Today we're sitting, we've seen a bounce back. We're about 5,400 on the S&P 500, but still a lot of uncertainty. I'm going to let you jump in. That's the stage. Here we are in the midst of this. What's going on, Sean?
I think there's exactly that uncertainty. We've had good returns that we're coming out of, and now people are not sure what's going to come next. So I think if you look at boardrooms down to individuals, nobody knows what's going to happen. And that uncertainty really creates volatility. And we're seeing that play out in stock prices. So stocks are a volatile asset class. There's a lot of dispersion in the returns. And if you can look at that over history, that can be good for things like tax harvesting, but it can be bad when things get uncertain. And so stocks are the volatile asset class. But the thing that I think is important is really portfolio construction, right? So if you have a well-diversified portfolio, there's other asset classes that are involved. There's bonds, there could be real estate, there could be private markets around equity or credit, there could be other assets as well. And they all behave a little bit differently to these different factors and risk and return drivers. And so it's important for investors to take a holistic approach to their portfolio and to really look at different markets. I hear a lot of people saying, oh, the market's down. Well, the stock market's down, but that's the US stock market. International stock markets have been up. Bond markets have been doing well. Real estate has been resilient in certain areas. In other areas, it's trouble. So it depends, there's a lot of uncertainty from market to market, but I think what's going on at the national level will impact everybody from corporate boardrooms down to individuals, and how that plays out is unclear. And I think that's what creates a lot of the volatility and uncertainty that we're seeing and experiencing.
Yeah, you noted there other asset classes, other things like international stocks, for instance. As we talked today, international stocks are up a little over 6%. Now they've kind of gone through a little volatile stretch as well, but not quite as volatile as U.S. So is that something you're saying like, hey, why not international stocks?
No, we shy away from timing in any kind of way like that. So our process is really to, you and I both sit on the investment committee. So as you know, we design portfolios with our best thinking, and that's from an asset class construction standpoint. We typically will include stocks, bonds, and alternative assets of various types. And how those are constructed, meaning the percentages that they have, where their geographies are, where their exposures lie, things like that are carefully considered. And so we've been a little bit underweight international over time, and that's played out well for us, but we still have it in the portfolio, and it's still part of almost all of our investors' portfolios unless they have concentration or something else going on. But for our well-diversified portfolios, they include an allocation to international as well as fixed income. And those would be two areas of the market that have been performing much better than U.S. equities, for example.
So let's talk about the process a little bit. I think certainly when you get in environments like this, you want to, I think our advice would be to look, you don't want to make any rash decisions. So to some degree, the work that you put in ahead of time allows you to make it through these environments. Talk a little bit about the process that would be involved and hopefully the time spent ahead of time before you get into these volatile situations. How do you set it up ahead of time so you are protected in these environments?
Yeah, well, great questions. It kind of gets back to our liberated wealth process, which is kind of a 3-step process. Starts with discovery. So that's really learning about your facts, assumptions, and goals as a client. And that's imperative in order for us to construct a portfolio to meet your needs, whether that's cash flow or liquidity or growth objectives or whatever. So that's step one. We'll then go into a design phase, kind of a project phase, if you will, where there's some heavy lifting. We're considering different solutions. And that's where we want to, we might design several iterations of a portfolio, but it's meant to be tailored to you, be custom to what you're trying to accomplish, what your situation is. And we as a firm are very focused on that process and making sure that we have the right design, kind of measure twice, cut once, if you will. And so we as a firm are also hyper obsessed with risk. So all of our portfolios go through extensive risk modeling. So we do stress testing, scenario analysis. We look at how these things behave. These are built for volatile markets. And so we know how the portfolios behave. We know what they're made of, but we need to understand you as an individual. We also need to understand how you think, how you behave, what matters to you. And so that's really where we spend a lot of time in the design phase, making sure that we have the right solution to cover all of that stuff.
Yeah, there was applied a little bit of an old sports analogy here of, people say like, these are old coaches and things saying like, oh, you guys are lucky you won. And it was like, luck is the intersection of preparation and opportunity, right?
Nice, Griff.
A little bit of the planning that goes into, it's not just luck riding out these type of volatile environments, but hey, you have to have a plan, you have to be prepared. I think from the committee on down to just working individually with our clients, it's, hey, we need to have a plan in place. And it always is that kind of being ready for a downturn. And if you have it set up right, then, hey, you can often take advantage of opportunities that, when you have a dislocated market, oftentimes you're looking for opportunities. Now, today's also unique. Like you said, there's lots of uncertainty. Not a lot of, we've got a little bit of at present, a 90-day reprieve on, or 90-day pause on tariffs and things like that. So it still doesn't lend a lot of certainty where you have a lot of facts to work with. Talk a little bit about, though, in constructing these portfolios of, why alternatives? Why, you mentioned that and kind of ran through it quick. Why do you like incorporating the alternatives to the portfolio?
Various reasons, but its very core is risk management. So it's about diversification. Individual assets are affected by different things, and that could be both on a return or risk side. There's also aspects of illiquidity. So alternatives, the ones that we like, are either semi-liquid or fully illiquid. And there's a return premium that can be earned for that additional risk premium of illiquidity. And so we like these markets. They can be challenging because there's good and bad investments out there, and they're big. And some places do it better than others. So we've really built out our team and our process to vet these alternative markets and make sure we can find sponsors who meet our criteria and what we're looking for. And we've really found great success with those sponsors over time. The illiquid markets allow investors to not see so much of the volatility. And that allows them to stay invested and feel more comfortable about it. Now, there's some argument like, is that really going on? Are the assets down? All that kind of stuff. But in private markets, there's often managers or other incubators that are involved to help steward along certain types of things, whether it's private equity and private credit. There's a lot of, different operators out there, but I feel pretty confident that our due diligence process weeds out, the best in class, and I feel confident with the ones that we have in there. So given the right alternative investments and the right alternative sponsors, they can create great diversification in a portfolio. So correlations can go down, portfolio risk can go down, and you can pick up some of that Arabian as well.
Is there anything there that could help? So again, this environment, a lot of the top concerns, and you have the Fed maybe even pausing for a moment to their of course their focus is on the labor market and on inflation. One of the concerns of recent years, inflation running pretty hot, still been pretty sticky. They have concerns there of lowering rates further because they don't want to just stoke this inflation, let it back out of the bag if it's not already out there still. Anything in alternatives that help with kind of outpacing inflation, honestly.
Yeah, I think looking at inflation, right? You have a higher real return that you need to earn on the investment. So things that can get outsized returns can definitely do that. Private equity, as an example, would be one that over time can outpace or keep your purchasing power intact as a result of inflation. The other is multifamily real estate. We really like that as an asset class because you have the ability to raise rents pretty consistently over time. And in being able to raise rents tend to rise with inflation. And so that tends to be an inflation resilient asset class. But at the same time, you could have a single tenant triple net lease and a long-term 30, 40-year lease that has very minimal rent bumps, and that might not be inflation resistant at all. So you need to be careful with alternatives, and you really need to look at them deal by deal and have somebody who's qualified in vetting those and understanding the different risk and return drivers look at those with you. But there are definitely cases where alternatives can make a lot of sense in a market like this.
And even, from a portfolio construction standpoint, even just going way simpler than that, I mean, we are in an environment now, we've seen interest rates come up. I mean, compared to the last 15, 20 years when, we saw such a long time of just zero bound rates and, 1%, 2%. How about the corporate side, corporate bonds, and maybe even delving into private credit? There's actually some attractive yields today.
Yeah, I think, credit's a different animal, right? Bonds are based on the counterparty, which is in corporate bonds. It's the companies of America that we're investing in or internationally, wherever it is. But it's the companies, same way as it is the equities, but the bonds are higher on the capital stack. There's a stated, interest payment along with a maturity period. And so I think when you're looking at the overall bond market, you need to be careful about counterparty risk. You need to look at where yields are, but generally speaking, bonds are a stable asset. They provide a ballast to a portfolio. They tend to be something that folks will go to in times of uncertainty. And so we definitely want them in the portfolio. They don't always behave that way. And, I've been doing this since 2006. I've seen bonds become more sensitive to Fed policy changes and news movements and things like that. And I think they maybe used to be, at least at the individual investor level. And things like ETFs allow you to, trade more actively and stuff. So I think there's some different attributes there. But if you own individual bonds, hold those through maturity, you're really worried about credit risk. And so I think as a whole, you have to look at the overall system and say, what's the health of America in this example? corporate America, right? And is there certainty there? And I think there is some uncertainty. So we're seeing yields widening out a little bit, but I think there's still opportunity there. I think that's still a safe place to invest. And when you think about, you know, the health of American companies, uncertainty doesn't mean that they're not selling products and making money and things like that. It means that they're not sure where they're going to invest and create their big capital expenditures, right? Where they're going to build out a plant or where they're going to have their manufacturing center and things like that. So as long as corporate boardrooms get clarity around tariff policy, fiscal policy, monetary policy, those kinds of things, they can respond. And then we as investors could look at their response and critique it and decide whether we want to own the equity or the bonds of those companies. But I think if you believe that America's in a good spot and that the overall economy is going to be better and stable, then bonds are a great place to invest and kind of ride out some of the volatility.
Yeah, and I probably missed I say corporate bonds, but you probably throw in the mix a little bit of U.S. Treasuries as well, which again yields up.
Treasuries, municipals. There's a lot of the bond market's big. It's the bedrock of this country in a lot of ways. You even saw President Trump talking about bond yields and how that influenced his decision to pause tariffs. And I think that was important. I'm kind of a bond guy, and I liked that piece of it. But 10-year Treasuries heavily tied to real estate borrowing, and so increasing yields there could have ripple effects into real estate. And so I think the bond market has a lot of indicators. I've always thought it was the smarter market myself, but I think it's a big, robust, diversified market that is important.
So let's just we'll paint a scenario here, and in this type of environment, how do you stay disciplined? Obviously no shortage of news and headlines to look at, but let's say you did put in the work. You created a portfolio, you designed it up to, that aligns with your goals and your time horizon. Then what are your options in this environment? I mean, one of the things that we've talked about is just staying true to your discipline, and one way of doing that is rebalancing. How does that help?
Yeah, so as simple as rebalancing is a good example. If one asset class has gone down and another has gone up, and you look at those in your portfolio on a percentage basis, selling the one that's gone up and purchasing the one that's gone down, it's kind of along the buy low, sell high principle. And I think most people would agree that's a good principle for investing. So rebalancing is a simple way of doing that and taking advantage of some of these movements in the market and portfolio that you're going to see. And I think you want to shy away from making any real big movements, outsized bets and things like that. There's, where there's risk, there's return. But I think right now with the uncertainty, there could be a little bit more speculation involved rather than strategic kind of positioning. So I think we need a little bit more clarity before you can opportunistically kind of create some strategy on what you want to do. But I think there are more and more opportunities out there that are going to surface in the wake of this.
Yeah, I mean, we saw in a period of 3 days when we were seeing 4 or 5% down, 4 or 5% down. You think back-to-back days, another day of call it down 2-3%. So then someone finally hits the eject button, which we're trying to avoid that, and then it rips the next day. Then they announce the news, hey, we're going to pause it, and it rips 8 to 10%. And so you're trying to avoid getting whipsawed and being in the wrong, trying to hit it just right. It's
price moves so fast. I mean, there's different studies out there you could look up, but if you're out of the market on the days the market moves, and it's only a small number of them, you miss the vast majority of returns. And I don't remember the exact numbers, but it's significant. You can look into it, right? But you've got to be invested. You've got to ride through the volatility. And again, the volatility is not in every part of your portfolio. It's not in your multifamily holdings. It's not in your storage buildings. It's not in your fixed income portfolio. It's not in your international portfolio the same way it is in your small cap stock portfolio, right? Those kinds of things. So I think you have to look at the different parts of your portfolio, but staying invested, understanding, trusting the process. If you have a plan with an advisor that you built for your situation that's well thought out and well constructed, talk to that advisor, have a conversation with them, let them know how you're feeling, understand what they're seeing, understand what they're saying about the portfolio. But at the end of the day, you have to have some trust and faith that This stuff's been thought through. We've been here before. We'll be here again. It's definitely going to happen every few years. We probably play this podcast back again in a few years, and it'll be relevant in some ways, right? So I think it's just volatility is part of investing, and I think we have a little bit of not a little bit. We have a lot of access to information. It's on and so media sells eyeballs, and the more eyeballs that are on there, the more money they make, and fear sells. And in times of panic, in times of fear, it's everywhere. I was at a restaurant with my son, and I heard 3 different conversations about people tracking interest rates and stock markets and this and that, right? It's everywhere. Everyone's talking about it. And I've seen that several times in my life, in my professional career, where things kind of get to this level. And so I think you just want to be calm, be disciplined, trust the process. And if you haven't done that work, by all means, contact us, contact someone, trusted advisor, have those conversations, because you do need a plan, you do need an advisor, you do need to have a well thought out portfolio in order to make it through the whole markets.
Yeah. One of the cornerstones of our philosophy is to provide our clients with the superior risk adjusted after tax returns. That's really our goal and what we put out there. For these high net worth, ultra high net worth investors that, tax becomes a big part, right? As they're hitting up in top tax brackets. Is there anything on the tax side, tax loss harvesting, things like that could potentially work in these environments? Obviously, there could potentially be some losses in some things in the portfolio.
Yeah, great example. So tax harvesting during volatility is a great thing. So look at the tax lots you have, or have your advisor do it. They should be doing that. Not contact us, but tax harvesting in your equities is probably the area where you'll see the most opportunity. We have the widest dispersion or most volatility in that kind of a market. So I would look to your equities first. Typically, we don't see a ton of it in fixed income. I wouldn't expect it too much in this type of an environment there. Real estate and the illiquid stuff, you probably won't be able to do much of that with. So for your U.S. equities, tax harvesting, what that can do is bank up some tax losses that down the road, when you take gains or do you have other gains in your portfolio, those losses can offset those gains and keep more of what you earn.
Now, I think you've done a prior podcast on that exact topic.
We did.
So go visit the Liberated podcast with Sean on tax loss harvesting.
Yeah.
Let's bring it home here, and again, maybe talk a little bit to that person to that individual that might be teetering a little bit concerned, and maybe they're in one of these spots as a business owner or a corporate exec, or even someone that was considering retiring soon, and they're just like, oh great, now this set me back. Maybe a little bit of a pep talk around some silver linings here. I mean, the ones I think about are, look, we tend to, as humans, get really focused on the negative and kind of extrapolate that out for years to come. And that, I think there's some things on this administration's agenda, like tax policy. There's, talk, okay, if there's certain deregulation that could free up investment capital to be deployed and things like that. I don't know. That's what comes to mind.
Yeah.
Anything else for you?
Well, I think if we break it down by groups, business owners are going to face uncertainty right now, whether it's corporate business, publicly traded companies, private companies, small, big, everybody's uncertain right now. So I think that's common. If you're considering selling or you want to sell, this uncertainty might not create the best environment for that. There may still be some transactions, but I would expect transactions to kind of, stall a little bit or look for some clarity. And to that point, there's a ton of money on the sidelines right now, and interest rates are pretty high on short-term stuff. And so you're earning a decent yield to kind of sit in cash, and there's not a lot of incentive to move that money off the sidelines. So if we see short-term interest rates drop, or if we see a lot of optimism kind of return to asset prices, I think we might get a little bit of a FOMO effect, and some of that money moving up the sidelines and moving into, whether that's in private equity deals or real estate transactions, or just more money flowing to risk assets as a whole. I think that's a potential that's there. So if I'm a business owner considering sale, what I would be doing is making sure you got your tax plan in place. when you exit that company, making sure you keep as much of that thing as possible is important. And so we do a lot of work with business owners on tax planning. And this is a perfect time to do it if you're kind of on pause a little bit from a exit standpoint, or if there's any uncertainty around that. Just make sure you've got your exit plan in place with your planners. And if you don't have one, contact us. We'll help you on that. Again, retirees is another group. Let me get to them next, because I think the other group that we serve a lot of is executives. And I think if you're an executive that's working with us anyway, most of the time you have a concentrated stock position. So that presents some unique challenges. You have concentration risk, single stock risk, things like that. So you want to be constructing the rest of your portfolio around that and mindful of some of those risks. And you're probably limited in terms of what you can do to hedge it or any of that kind of stuff. And so making sure you have a cash flow plan, making sure you have a plan for retirement, making sure you're doing things with the rest of your balance sheet is important if you're an executive. So again, we do a lot of that type of work. And then the last group would be retirees. Those are people that I think were either business owners or executives that have now exited that. Most of those folks are invested in a portfolio and using that portfolio for income in some way. Could be part of their wealth transfer plans, things like that. So I think it's important for them to look at stuff. If it's your cash flow producing assets, making sure that those things are covered is important. If they are growth oriented assets, making sure that you're looking at where there's opportunity. Is this a buying time at a place you could be picking up assets that have high return potential, but are now discounted from where they were over the last 7 months. So I think you need to just kind of look at each market individually, look at your plan, look at your cash flow plan. Hopefully, if you're in retirement, you have a cash flow plan and your advisor will take you through that and show you how the portfolio behaves in different market conditions related to that, all that kind of stuff. So again, if anybody out there is listening and not doing these things, let us know. We're happy to help. But if you have an advisor or you are doing these things, you got to just trust the process, work with them. That would be my advice in times like this.
Yeah, it sounds great. I think the last couple of years, look, there have been, there's predictions of slowdowns, call it, likelihoods of recessions, people trying to wait those out. It's really been like that the last 2 years, right? There's been all these projections of 2 years ago once they started raising rates. I think the last couple of years, it's been the resiliency of the consumer still out there spending. Maybe 2025, it's the resilient. We'll see about the resiliency of business owners and corporations and how they navigate this new policy, right? I mean, it seems like everyone's trying to figure that out. How do I navigate this? And it becomes pretty tough to do in uncertainty, but I think just everything like everything else, it's better days ahead and keep powering through. And I think as we work with investors, it's similar of like, hey, let's dig in, make sure this investment plan we've created for you is still tight. It still aligns with what the whole purpose we set up in the first place. And, I love even just the simple things like the rebalance. It sounds so simple, but there's plenty of studies. You mentioned some other studies on just being in markets and missing those days. And there's plenty of studies on rebalancing as a way to really outperform, is staying true to your discipline. So
Exactly.
So yeah, I think with that, RJ, we're gonna wrap it up here.
That sounds good. How about some contact information? And we'll start with you, Sean, first.
Sure, yeah. You could visit our website. That's centurawealth.com. We've got a bunch of stuff there, as well as our contact information, or you can email me directly at sclark, that's CLARK, at centurawealth.com.
And my email is my first initial M, last name Griffith, GRIFFITH, at centurawealth.com.
Excellent. Thank you, gentlemen. And thank you for listening. Most importantly, we appreciate the listeners who listen to Live Life Liberated podcast with the team from Centura Wealth Advisory. If you have not subscribed to the podcast, please click the subscribe button below. This way, when the team comes out with a new podcast, it will show up directly on your listening device. And we humbly ask you to share this podcast, rate it, and leave a review, because this actually helps others find the show. Again, thank you for listening. And for everyone at Centura Wealth Advisory, I'm RJ Malik, reminding you to live your best day every day, and we'll see you next time.
Thank you for listening to the Live Life Liberated podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Centura Wealth Advisory. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Centura Wealth Advisory, Centura, is an SEC-registered investment advisor with its principal place of business in San Diego, California. Centura and its representatives are in compliance with the current registration and notice filing requirements imposed on SEC-registered investment advisors, in which Centura maintains clients. Centura may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Past performance is no guarantee of future results. Tax relief varies based on client circumstances, and all clients do not achieve the same results.